Now here's Myles with our chart of the day.
All right, so earlier we had talked a little bit about the consumer confidence number that we were going to be discussing later in the program. Well, here we are. What we're looking at is the present conditions index from the Conference Board's latest reading on consumer confidence. Now, certainly quite elevated, right? This number right in the 170s for the last several months, but you'll notice here on the chart a large drop in March, the largest one-month drop, in fact, that we've seen since October 2008. Now, why does this matter? Well, present conditions, the present assessment that consumers have of the economy is more or less a read on how people feel about the labor market. If you have a job, you're going to feel good. If you're getting paid more money, you're going to feel good. That's why this chart has pretty much been straight up and to the right for the last few years. If you pull it back even further, if we were to do a 10-year chart of this index, for example, you would see a very sharp recovery beginning in, well, about late 2009, early 2010, just like a number of other economic indicators. And so what it really says to me is that we do need to be careful here watching the labor market. We've talked a little bit about the slight uptick in initial jobless claims. Don't want to make too big a deal about that because claims are still right around 300,000 per week. So it's not a huge change we've seen, but they have ticked up a little bit over the last 6 months. We have seen a lot of other data that suggests the economy is, growing at a slower pace, not the least of which is, kind of GDP assessments, Atlanta Fed, New York Fed, what have you. But we've seen a slight slowing in the pace of growth from services and manufacturing. And, really ultimately, the economy is about the labor market. And so if this chart is showing some kind of cooling, it's just something to note. That's all. Not trying to ring the alarm. Not trying to ring the alarm. Just saying things were good, but they're not as good.
Does it have anything to do with the fact that wages are going up?
Well, that's why the chart was doing well, right? So the question is, why did you have the largest drop in 11 years last month?
And this might be kind of disconnected, but what do you think this means in terms of inflation? I mean, this is something that the Fed's been struggling with, but if consumers are not going out and buying things, I got to ask you a Fed question now.
As you know, the Phillips curve, if it's not completely broken, it's certainly flatter than we thought. And I think the fact that this reading has been so strong, and yet wages are only finally now starting to pick up, and inflation is nowhere to be found, sort of says, to the textbook side, says, well, R.I.P. Phillips curve.
R.I.P.
There you go. It was good while it lasted. Thank you, Phillips.